business news, we're news for business people.
Good afternoon, you're watching Bloomberg Quint Live. I'm Alex Matthew and these are the headlines at 12. It's a fourth day of gains for the markets. The Nifty has now gained for 6 straight sessions. Both benchmarks hit new highs. Coal India is the top gainer on the Nifty after it approves the revision of non-coking coal prices. The real estate index is the top sectoral gainer today, with all its constituents trading with gains. The Telecom Commission will meet today and try to finalize its recommendations on a relief package for the sector. And with that, it's over to Darshan Mehta for Hot Money.
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then. Umesh Mehta of Samco Securities, market expert Dharmesh, Kant of and investment advisor Vivek Mavani join us on the show. Dharmesh is running a little late, so he'll join us on the show in a while. Today on Hot Money, we'll discuss stocks like Idfc Bank, Prakash Industries, the top pick from the media sector, and we'll ask them for a long-term investment idea for 2018. Now let's start with the first stock, and that is Idfc Bank. Was on a tear yesterday. Market rumors indicated a potential merger with an NBFC, and later in the day, CNBC broke a story indicating that there could be a potential merger with Idfc Bank and Capital First. So what could this mean for Idfc Bank? We'll ask our experts. Vivek, Idfc Bank's been trying too hard to do a lot of things, but somehow it just doesn't work out for Idfc Bank. Now this is the new thing that they're trying. I don't know whether this merger with Capital First is happening or no, but what if this happened, what does it mean? And on a standalone basis, what do you make of Idfc Bank?
Well, quite honestly, to answer your last question first, what does one make out of IDFC? Well, I would love the IDFC management to tell the world, not just me, but tell the world what to make of it. In the sense that 2.5 years ago, I mean, October 2015, when they got the banking license, it was demerged from the parent IDFC, where the financial institution, I mean, as an NBFC and the bank, I mean, was separated out. I mean, even standalone for what they have done in the last 2 years or so, it's been a rank underperformer compared to all banks in terms of whether it was a branch rollout, whether it is technology initiatives, whether it is a retail deposit growth, CASA as we call it, current account, savings account deposits. It's been an underperform across all parameters. That's number one, for whatever. I'm sure the management 3 years ago or 2 years ago when they got the banking license, and I'm certain RBI certainly didn't make a mistake of granting a license to IDFC in terms of their pedigree, parentage, management quality. IDFC was among the two who got the banking license at that point of time. I'm sure they had a growth strategy over the next 5-10 years, and in terms of after converting to a bank, what are they going to do about it? But last 2 years, what we see is the management seems to be iffy or not having the confidence in their own growth strategy or the plan that they hopefully had at that point of time, and they continue to have. First, the flirting and a likely marriage with Sriram Piramal combined, that went on for 6 to 9 months, due diligence and multiple rounds of dilly-dallying in terms of, and now with Capital First. Let's put things in perspective. IDFC was an NBFC. It was demerged into a bank, and if IDFC Bank repeatedly seems to be having an urge to merge with an NBFC, whether it is Shriram or Capital First or whatever, then where was the need to demerge? I mean, they could have just continued as an NBFC and grown the business as an NBFC. I mean, it seems ridiculous that it gets demerged, gets a banking license, gets demerged, and then again wants to become an NBFC itself. I mean, the things just don't seem to be fitting in. Coming back to performance, I mean, as I mentioned, so some of the other private banks, I mean, HDFC Bank or a Kotak Bank, whether it's technology, whether it is growth in deposits, growth in advances, quality of the balance sheet, everything. I mean, some of these older banks, older private sector banks, which are 15, 20-year-old, seem to continue to do better. Well, IndusInd Bank, I'll add that also. Quarter after quarter, they are delivering. IDFC just disappoints. And you have all these news which are more amusing than having much substance. Valuation wise, at 1.2 times price to book and 6-7% return on equity. I mean, it's just doesn't make an attractive investment opportunity. Maybe one can just play on the news in terms of trading. I mean, okay, on the lower side you have 54, 55, on the higher side you have 70, and you have those multiple cycles, maybe about 2 cycles a year. But I think that's about it. I mean, I really don't see a long-term growth story or an investment call in IDFC at all.
Okay, Umesh, do you share the same view on IDFC Bank?
No, I too share the same view. A decade ago, when RBI had given licenses, so that time the stage was growth, and like HDFC banks and all those Kotak's banks have really prospered. They have penetrated and they have captured a large market size. 2 years ago, when RBI, in fact 2 or 3 years ago, when RBI again issued licenses to around 10 or 12 odd entities. So now these guys are finding it really hard to penetrate. For example, HDFC Bank has got 4,000 branches, and this guy is still below 100. Correct? So they really have to push in hard to scratch. So now today, so another point for inside of IDFC Bank is, today is the time of technology. We don't require branches and all those things, and we will save costs. But that is not happening. Currently, the mindset of the people is such that they really want brick and mortar banks because they are putting their hard-earned money, and ultimately, for any bank to survive is what CASA, current account and saving account, because that's a low-cost money that they have, and that's how they drive growth. They can lend. So that's not happening, and now those things are not happening, and therefore the bank is now crying to get the growth and try and get merged or acquired, and currently that speculation that we are seeing. But people have that bias that if HDFC Bank and all those banks, when they have become so large, so now currently all these banks, this is a starting point, let me invest. So that I think is not going to pay off. It is better not to really get into this because it may not really take off. There are so many banks, and this bank may be just an ordinary bank. So then, how as an investor, he protects his capital, he protects his growth, so that is money. So I think all those factors, when as an investor he considers, I think it is better to avoid this
Okay,
stock.
so it's two negative views that's coming in on IDFC Bank. Dharmesh, do you think that IDFC Bank has got its strategy absolutely wrong, or nothing seems to be working for it? What's your view? We have two negative views on it. What do you make of IDFC Bank?
So mine is more of a neutral view, and it's rather than getting the strategy wrong, one has to understand banking as of now. What is banking all about? It's all about retail thing. So last 5 years we haven't seen any corporate banking, taking off, any corporate loan growth, and that has been a big concern. So when IDFC, got demerged into IDFC and IDFC Bank. So IDFC Bank was still, more into corporate side, and they wanted to have a retail CASA base and retail, growing, and that is where the difficulty is. Anybody who is starting up fresh, who doesn't have a background of retail, client, cannot just run a banking system. So if you see MFIs or NBFCs which are getting banking license and doing well, for example Bandhan, so they have a huge base, retail base is already in place. You just need to get a license for banking and you get a CASA and things get rolling out. In the case of IDFC, it was a fresh start. So that is where the problem has coming, and this will be a problem with anybody who starts a banking system who doesn't have a retail base. So MFIs getting a banking license, or NBFCs who are into retail consumption side, white goods, consumer durables and all, they getting migrated into banks is fine, but that is where IDFC is lacking, and it will be very tough and difficult for it to take it forward. So this rumor like getting merged with Capital First and all, I think it's a positive for IDFC Bank. So because Capital First already has a large client base, and with this happening, they getting a banking license, that will immediately you will have a retail access where you will have your CASA growing. So business wise, be it NIE and everything will fall into place. So I think eventually this will be the future for IDFC Bank.
Okay, so not very encouraging views coming in from our guest on IDFC Bank at this point of time, trading in the negative currently after a massive rise yesterday. The next stock that we want to discuss is Prakash Industry, and the stock is is certainly buzzing. One of the best performers over the past few months. Results were there yesterday. Extremely strong set of numbers. Revenues was up 62%. Margins at almost 21% from 14%. And the management has guided in the fourth quarter the margins will be 25%. Sales volume of 35% in the fourth quarter, and turnover rise by another 60% in the fourth quarter. So extremely bullish comments coming in from Prakash Industries. What should one make of Prakash Industries? Dharmesh, I'll start with you.
Yeah, the numbers were excellent set of numbers, and primarily operating leverage played out. Their steel capacity was running at around 80% kind of capacity it was running on. Power has also done very well. Even there you have got a margin expansion, and that would be next trigger. So as the power offtake increases, so that will again lead to a healthy margin, and valuation wise is still cheap. The next big trigger for Prakash Industries for getting re-rating is the start of mining. First would be the Odisha mining, which is likely to commence in April 2018, and then the Chhattisgarh one at 2019. One, it will help in backward integration for the own input cost, and other as the steel demand is going up and iron ore traction is picking up because China is going slow. So it's very conducive for the industry. Valuation, I think it's trading at, if you base at FY20 earnings estimate, it's still around 9-10 times PE multiple. So that gives you a significant scope for re-rating. Okay. Only concern here is steel capacity. It's around 1.2 million tons per annum. Though management has guided it for 3 million tons, but it will take 5 years. The good point is it will be through internal accruals, so no debt overhang there. But now you are already at 80%, and the type of growth you are seeing in the steel, so 20% is the hardly, where 100% they are guiding for this quarter itself. Yes. So then what next? Next 1 year you won't be having any steel, traction happening because you are already at 100% capacity. So that's why I think much has been priced into the stock. But if one want to keep it for 3 to 5 years, it's a good value buy.
Okay, it's a good value buy. Umesh, what do you make of Prakash Industries? The numbers were good. What can we expect in the fourth quarter and the year ahead if someone wants to take a view at Prakash Industries at this level?
Correct. If someone really has to understand the business model, this is our cyclical business, right? And operating leverage is, when they come in, these are the kind of growth in profits that we see. So this is what the Prakash has delivered. So a slight increase in their top line, in fact 40%, but volume part is muted. So the pricing, because of pricing, ferrochrome prices and steel prices have gone up, they have able to notch a 40% higher volumes, and therefore a larger than expected increase in profits. So this is how all commodity companies behave. So the question is whether this kind of growth will sustain and it will carry on. The answer is maybe yes, maybe for 1 or 2 odd quarters till the time we have that low base effect and till that entire pricing cycle is completed. Yes, we will see. And given the valuation 10-12 times P multiple, yes, short to medium term, I think still the stock has potential and it can grow. But the biggest threat, while investing, from long-term perspective is that today China controls 50% of steel capacities, right? And China is Raja-Shahi sort of climate. So wherein it takes one night to decide to increase the production or cut the production. So if prices are rising and there is no reason why China will stop or will still curtail their production capacity, in fact they will increase that, because if profits are coming and if companies are making money, no country will like their companies to not to make money at the cost of other competing countries. So I think that is the biggest threat. And sooner or later, I think, and this threat will come live, but it will be silent. So people will not understand when the prices have started coming down, when the capacities have started to increase, because they don't track the global environment on a daily basis. So that's how the entire game has to be, played. They need to be cautious, but at the same time momentum is there. Yes, bull market is going on, there is liquidity, and these are the stocks which liquidity will now, will go, because there are margin of safety, because given the valuation and growth, I think still one or two odd quarters stock can perform well. But the risk that one has to keep in mind.
Okay, so that's the view. Vivek does not track the company and does not want to give a view. So that's the view that's coming in on Prakash Industries. Both our guests, Dharmesh as well as Umesh, have a positive view. Valuations are clearly there, but both of them have highlighted risks in terms of capacity as well as the China factor which is there. Before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, media as a pack has been doing well. So as a theme, we're talking about what can be expected from media going ahead. So we'll ask our guest what are the topics that they believe in the media space. And Umesh, I'll start with you. You like TV today. What's the rationale and what do you like about TV today?
Correct. So media and entertainment industry, there are two ways of generating revenue. One, create content and then take advertisements, or give news and then get advertisement revenue. I think so that's a two clear focus. And the third is your cable operators and all those things. So let's focus on this media and entertainment. So conglomerate like Z and Sun TV, you know, they have a conglomerate. They create content, they deliver news, and that's how they have become large. But TV today, you know why? They are only focused on news, correct? And news typically in the Hindi world, you know, because in India, in English and Hindi, the ratio is 1:10, you know, so that's the viewership. And currently the penetration in India is 63%, and that is expected by 2020-21 to 67%, and more or less there. So there is a huge penetration, there is a huge potential that still has to be captured. And the advertisement revenue. So now TV today is one of the most efficient, most focused, most consistent media player with clear focus on news channel. So they had already ventured earlier into radio, and they said no, this is not our focus, let us sell. Then they got into hurdles and they went into litigation, but now they have withdrawn and said fine, we will also focus into radio because that is going because that is also growing at 14%. So given the valuation now, so let's compare valuation. So TV today is available at half the valuation of Z and Sun TV. So we have also seen that creating a content is very risky, because at times it may pan out 8 out of 10 times content really, you know, does not click. So out of 2, 10 out of 2, you know, that's the ratio, you know, 80-20. So 20% of the content really has to pay for the balance 80%, and that really has to click. So currently in social environment, social media, people are consuming content. But because of social environment, people really don't believe in news. So news, people will have to go to channels, television channels, having brands, having established track record. And that's how I think TV today is really one of the mid-cap stock which can really deliver growth. TV today is what, 2,500 crores market cap, and Z and Sun TV are what, around 40,000 crores, and available at 40p multiple both. And this is available at 22p. Growth is better than Z and Sun Tech, this thing. So 3-year growth, TV today has given 18%, and those guys are given 10-12%, right? And ROE is pretty decent, you know, around 18-19%. So I think on an average, given the valuation, given the setup of business, the focus, I think they are going to perform better in long
What's
term.
the margin difference between what TV today does and compared to Z?
So I think TV today is around 28%, and those guys are doing 23 to 24%.
Okay, so
margin still they are better.
Yeah. And what's the key risk that TV today has? If someone wants to invest, what would be the key risk that TV today runs into?
Correct. So risk in terms of business, you know, competition can really try and, you know, fizzle out all those things. But 16 years of experience, track record, and undaunted conviction to deliver news, I think that is one of the biggest strength one should look at.
Okay, so Umesh's pick is TV today in the media space. Vivek, which one do you like?
Well, I like the, as he mentioned, the conglomerates. So I like Z Entertainment. Couple of things. In the technological disruption which is happening in the overall media and entertainment space, those with good quality content and a track record clearly stand out, because what is getting disrupted is the distribution pipelines. So you have your traditional cable operators, you have your DTH and all that, and now wireless is coming. I mean, Jio TV for Jio, for example, is delivering television over wireless networks. So in terms of whatever be the medium to transmit the content, guys always will be the winners, those who can constantly generate good quality content that has sticky subscription and viewership. As a result, you have sticky advertising revenues. That's one side of it. Now, as penetration grows, as the payable viewership grows, subscription probably will grow slightly higher than advertising, but advertising itself will grow at about 15-18%. I mean, as the economic growth. I mean, historical trends suggest, I mean, advertising growth in the economy itself is about twice the GDP growth, twice or 2.5 times. I mean, when I say 2 to 2.5 times, that's because certain parts of the media will grow slightly higher, certain parts growing lower. So probably print will grow lower, electronic media and online, digital, internet and all that probably will grow faster. But that's a small part of this thing. The largest, of course, is television, and in the foreseeable future, television will continue to remain. Going forward, if we look 2 years forward, 2-3 triggers. Advertising growth likely to step up as multiple sectors come back to growth. So when we talk of overall market, when we talk of earnings coming back, obviously those same companies, whether it is FMCG companies or auto companies or real estate companies or so on and so forth, sector after sector, if we are going to see an uptick in earnings growth, so is their ad spend also likely to grow to sustain that higher sales and profit growth. That's one side. Next 2 years, we have 9 or 10 state elections and the big general election April, May of next year also will give a certain boost, one-time boost. Of course, it's cyclical, one-time boost in terms of political ad spends also, which could be like a few hundred crores over the next maybe 2 years in that sense. Value coming now to the valuation. Okay, so basically a 15 to 18% revenue growth over the next 2 to 3 years or even 5 years, if I were to do a little crystal ball grazing, is sustainable.
So this is applicable for all news channel. And Z is one of the most expensive. So why Z over someone? Well, so valuation wise, are you comfortable with?
I see at about 30 times 2019 earnings. And about 16-17 times EV by EBITDA, zero debt company with multiple subsidiaries where value unlocking has already happened. I think at about 30 times to 2019 earnings, I think it's reasonable, because one also has to look at if I were to compare Z with not just other media companies, because the media universe is pretty small. In that sense, you just have about 7, 8, 10 companies to really compare, including the print media. But if I were to look at this as a consumption story, because this rides on the consumption. I mean, just like we consume products, we consume entertainment, we consume media. So, so compared to all other consumption stories, in terms of size, scale, track record, consistency, high margins, return on capital of about 18-20% consistently year after year for the last 15 years or maybe about 20 years. And
I'll have to cut you because we are running. Fine. So I need to move to Dharmesh. Dharmesh, what's your pick? So Z is the pick that Vivek has pointed out. What's your pick on the media space?
See, as a space media, I don't like. More of a neutral to various kind of. And there's a reason. Like as far as news content is concerned. Everybody has the same news. The same has to be telecast on all the. You keep on surfing channels, the same news is being played. What matters there is a view on the news, which is a person-specific thing. So the views which are being liked is more of like a movie thing, like whether it's Amitabh Bachchan or Shah Rukh Khan who is doing the movie, you're liking that or not. So news per se, I don't think that it's going to have a very good traction. Very high competition in the space. Content aggregator, everybody is the same content, or more or less as far as aggregation is concerned. Content, development is something which can give you an edge. So nowadays, if you look at any entertainment channels, I mean GECs, so what you will find out is the same, serials are getting replicated by other channels as well. So the catch up is again really very fast. How they are going to make money going forward is a big question mark. Okay. Because of stiff competition, advertisement rates are going down, basically it's crashing. So in that situation, I don't find the multiple negative valuations which are there will sustain.
Okay, so that's the view that's coming in on the media space. Umesh is bullish on TV today. Vivek's pick is Z, and not a very positive view coming in from Dharmesh. And finally, we're asking our guest an investment pick for 2018. Dharmesh, you picked Tata Motors. What's the rationale?
See, Tata Motors, firing all the cylinders. It's been on a turnaround stage. The Indian segment has again picked up. MSCV, LCV, the numbers were very solid. And it's been with the industry, be it Ashok Leyland and M&M, all have been delivering well. I think this traction is likely to continue going forward. The JLR has been doing well. Okay. There has been mix in some few geographies, like sometimes Europe picks up or China picks up or US picks up. But on the balance, it's doing well. They are coming out with new variants which are cheaper in price, conducive to Indian consumer sentiment. So if that launches comes through in India, so JLR sales will pick up, and the last December numbers were very good, JLR sales in India. So that is again going to pick up. huge operating leverage is there to be played out in Tata Motors. And my own sense is by FY20, the earnings will double from where we are standing as of now.
Okay.
So 50 is the EPS earnings I am looking for Tata Motors by FY20. And then the stock is very cheap. So even if you go 12, 13 kind of a rating on the FY20 estimates, so price will be 650, 700.
Okay.
So a lot of money lying on the table.
Okay, so Tata Motors is the pick that Dharmesh is saying 650 to 700 is the target that he potentially sees. Umesh, you like Mahanagar Gas. What's the rationale here?
So, given the new construction that's happening out there in this city, everyone will have to, get into that piped gas. So, this is a sort of monopoly business for next 20 years, having pricing power, and the volumes will be pretty decent. 8 to 10% growth is visible, and there is a slow and steady shift from traditional to the piped gas. That kind of business generating an ROE of around 22% is a much more stable model, from in long-term investment point of view. There is nothing is going to disrupt this kind of model. And the consistency and the growth will lead to earnings multiple expansion. And why this and not IGL is because this MGL is having an operating profit margin of 35% and IGL is having a 25%. So inherently, I think they are, and they have also got new licenses for Panvel and Pune region. So I think growth, visibility, sustainability is there. So I think that's going to be a big trigger for the stocks to get re-rated.
Okay, so MGL is the pick over IGL in the gas space for Umesh at this point of time. And finally, Vivek, your pick is JK Tires. Quickly, you'll have to.
Yeah. So basically,
what makes you so positive on JK Tires?
Okay, so basically among the entire auto ancillary space, auto ancillary space, between valuation and growth metrics, JK Tires seems to be most favorable and highest sensitivity to growth. 3-4 things. The first, benign raw material pricing, barring crude, so the synthetic rubber and rubber chemicals which are crude based, so that's a slight joker, but the positive against that is little of pricing power seems to have returned to the sector, so they have confidence about increasing prices every quarter, which JK and MRF and Apollo, at least that are leaders, have been doing that. So the cost increase is getting passed on, maintaining margins. Number 2, JK acquired the Haridwar unit of Birla Tires last year, April of 2016, which was a shut unit, loss making. Obviously, there were fixed costs to be taken care of. JK Tires has now turned it around, so now that unit should start churning in profit and operating leverage playing on increased capacity utilization. 3, the volume growth in the sector itself on back of primary sales of auto. So as Dharmesh mentioned about, so basically commercial vehicles after a lull, growth has come back to high double digits. Passenger cars at low double digit continues. Two-wheelers again have come back to double digit growth. So basically all segments, tractors again has been a consistent performer. So all parts of the auto sector, primary and secondary, seem to the volume growth has come back. Last year, the twin impact of demonetization and GST led to certain volume impact over a 3-quarter period between last December quarter to till about June or July, where destocking because of GST related led to lull in volumes. That all is coming back. So normalization in terms of volumes for the dealer inventory and all that seems to be coming back. So what we are looking at is margin expansion, volume growth, and hence a substantial profit growth, and over the next 3 years deleveraging of about at least 500 crores per year of debt getting repaid. So over the next 3 years about 1500 crores of debt will get repaid.
Okay, so I'll have to stop you, sorry for the time, but JK Tire is the pick that Vivek has on the call. Before we end the show, here's a quick recap of all the guest views on the stocks that we spoke about right now. Okay, Dharmesh, Vivek and Umesh, thank you so much for joining me on the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.